Okay, welcome to FOMC 15th of June. It's just gone 6:50 here in Dublin, and we are looking forward to what is definitely going to be one of the better FOMC data events that we've seen for quite some time. So we're just going to give it a couple of minutes and let a couple of guys come in on the Duggan Capital Room here and on YouTube. Hope everyone's doing well. We'll give it 2 minutes and then we'll get into just a bit of chat here about what we're to expect from the statement and from Jerome. Commenting on how the market has gone so far today, we can kind of jump over, have a wee little gander on these charts. It's been, it's relatively positive, up 1.4 NASDAQ, 0.7 currently up on the SPOOs and 0.3 on the Dow. It's all really just hovering just a little above VWAP or below at the moment. Oil's been really lethal down here. You can see the range on oil. It's round tripped. Let's see. Probably like 1, 2, 3, 4 times. It's kind of round tripped about 1.69% each time. So kind of $2 round trips all day, making incremental new lows throughout the day below S1. I think we could actually, definitely get down to the 20 at some point, and 113.30s is a target there. But we're not going to look at oil this evening. We're going to be looking at equities. We're going to be looking at the dollar. We're going to be looking at T-notes, all the sort of, other stuff, right? So nat gas is, up. It was up around 6% earlier on in the day, sort of licking its wounds from that Freeport problem in Texas. Of course, the port export LNG terminal is damaged, and it could take towards the end of the year to fix that terminal. And so with that, the gas that's the LNG that's meant to be exported to Europe is going to be held back, and therefore you're going to have an overload of supply at the terminal and generally in North America. That's why we came off about 18, maybe 20% actually yesterday on nat gas. And so just looking at swoons back to the upside now, just below the 50 EMA. Actually, it's a 50 weekly EMA you're looking at there. Just on the bottom right beside my head. So anyway, 3 minutes gone now. So let's bring it back to the main screen. Right, I'm going to keep this pretty succinct because in 7 minutes time we are going to get the statement out of the FOMC. All right, so really to wrap this up as sharply as I can, just got to make sure the squawk is going there. All right, so the base case coming into this meeting has been that the Fed will do a 50 basis point rate hike. There was talk in the last meeting that they would take 75 basis points off the table somewhat. All right, they're not completely ruling it out, but they were really looking to stick with the 50 basis point hikes for the May and June meeting. So we're at the June meeting now. Now, the one thing that's thrown a spanner into the works here is that the CPIs came in at 40-year highs. Okay, so really, a price producer today, yesterday I think it was PPIs, but CPI is a big one, came in at a 40-year high, and so that sort of led Barclays and Jefferies first to then ramp their expectations up to a 75 basis point rate hike rather than a 50. And the sort of founding for them to do that is that, the Fed would stay at a 50 basis point hike should the data react as they expect on inflation. The data came in, a lot of people are saying it came in stronger than what they expected, and it probably did. And therefore, that is the caveat then for them to raise it to 75 instead of 50. So Barclays and Jefferies, as I've said, went with this first. And then you're looking at, the most of the rest of the street has come out 75 basis point hike. So we got 5 minutes now until the statement. I ran a poll here on Twitter just leading up to this, starting earlier on this morning. We've got about 69.1% of respondents, saying it's going to be 75 basis points. Each and every respondent was, of course, a Nobel Prize winning economist in their own right anyway. So look, upward, 75 or 50, either which way, for me and for a lot of the guys in our room, we're not going to make money by second guessing what it's going to be. We're going to make money by reacting to what the market does on whatever data we get. Okay. So, you can have all the meetings you want about, what words are going to come out of, in the statement and then out of Jerome's mouth. But really, the rubber meets the road when, you have to get that trade on and the market is either reacting in an area where you want to take a trade or it's not. So yeah, that's really it. There's probably been, I would say, 1,000 hours of television dedicated to going from 50 basis points to potentially 75. I've done it there in 3 minutes and saved you a lot of hassle. So, and a lot of conjecture. So, we're going to just really put it into the room here. Anyone have any comments? Lewis is definitely got the wine in at the moment. Luca probably as well. Good stuff, lads. Let's go back on these charts and have a little gander. You're seeing oil. It's done this so much today. So it's washed out on the downside. Found buyers, come back up on VWAP, then pipped above, probably into the +1 here, and then sold down again. So it's been absolutely vicious. So you really need to be working this thing from VWAP with a lot of risk. Anyway, what are we doing? So let's look out in the dailies now. We got 2.5 minutes to go. Let's just go on the SPOOs for a quick look at how equities may sit here. It's actually looking quite bullish on the daily candles, as you can see right here. So I'm just going to make that a little bit bigger. Looking quite bullish, and really this is the zone for me. I'm interested in 36.14 halves to the downside. I think as we move down, there'll be buyers 36.75s, but ultimately I think we're going to have to slip down to 36.14 half. To do that, I don't see this market doing that in this session or this week so far. I think we are going to need a pullback, and so dovish is going to be 50 basis points. Hawkish obviously is going to be 75 basis points. So I think if we get 50 in the statement, I think we're going up. We're going to be 38.09's quarter very quickly. We're going to be also then up above the R2 at 38.77's very quickly, and we'll close the gap where we opened the gap there on Monday, reopen on Globex. And that's similar stuff on the NASDAQ. If it's a 75 basis rate hike, I think we'll do 38.09s potentially very fast before then coming off to the downside, breaching the 37.52s again and targeting 36.75s. That's it in a nutshell, really. So we got coming up on 60 seconds here. Would I trade oil on this? No, not on the data. Not on the data. Going to switch over to the squawk.
75 basis points, which is most people's expectations now, if that's the case. Then go through to the dot plots for the Fed rate, and then go through the rest of the material and any changes to the statement.
Ivan Deep and Josh, hey lads, hope you're doing well. Good to see you out. Spoo's taking a bit of a bid here. All right, I'm going to put the Spoos down and we can watch these markets trade. Gold, bottom left.
10 seconds.
Here we go.
75 basis points. 75 basis points as expected there. Looking at end 2022, free spot 4% implied median dot. For 2023, free spot 8%, and 2024, free spot 4%. So that is a 75 basis point hike to a Fed funds target range of 1.5 to 1.75%. The 2022 end Fed median dot is seen at 3 spot 4, up from the prior 1 spot 9. The end of 2023 at 3 spot 8 from the prior 2 spot 8. The end of 2024 is at 3 spot 4 from 2 spot 8. There was a 10-to-1 vote split where George dissented, favouring just a 50 basis point rate hike. Just looking at the inflation forecasts. I haven't seen core PCE yet, but regular PCE inflation is seen at 5.2% this year, up from 4.3%, 2.6% next year, 2.2% in 2024, with median inflation in the long run that remained unchanged at 2%. Sees growth at 1.7% this year, the Fed down from the prior 2.8%, with next year's seen at 1.7%. 1.9% in 2024, and the long run left unchanged at 1.8%.
Okay, I'm going to leave the squawk there. All right, so you've seen a bid come in on equities from this, but quickly taken back here. So we're really treading pretty much exactly where we were, sitting on VWAP now. 28 minutes to go until we get the presser. We've had the 75 basis point rate hike instead of the 50, as was the base case. And the market is really finding it hard to go up here. So we were, in the pre here, talking about the 75 essentially being hawkish as opposed to the 50, obviously. But the market is kind of looking like for now that it actually had the 75 fully priced in.
Activity appears to have picked up, job gains robust, inflation remains elevated, reflecting pandemic-related supply and demand imbalances, higher energy prices, and broader price pressures. Fed says it's highly attentive to inflation risks.
Here we go now, a bit of selling.
Says that will proceed as planned. We weren't expecting any changes there. Says it's prepared to adjust policy stance if risks emerge that could impede the attainment of its goals. Doesn't appear to be anything in the statement to give much colour on hikes in the next meeting or so.
So Reed saying that these terminal rates are huge increases. Just want to get the audio sorted out here, and I can bring you on, Reed. Now here's seeing a bit more hawkishness on
and just looking at slight divergences between
on the equities, finding it very hard to hold above VWAP here.
Inflation ever so slightly. Says the committee now is strongly committed to returning inflation to its 2% objective. They've got rid of the comment that said, with appropriate firming in stance of policy, the committee expects inflation to return to its 2% objective.
Yeah, there you go. Now you're seeing selling pressure coming through. Oil's done another spin back to VWAP. I missed that while I was focusing on the equities picture here. Down to that 37.50s now on 52s on SPOOs. This whole hawkish scenario kind of beating through here. Shout out to Sean Grant and Brian Young on YouTube. How you guys doing? Reed, do you want to come in and comment at all audio-wise on the terminal rates? Sure, no worries, man.
And just regarding how many more hikes are implied for the rest of the year, that median end of 2022 dot at 3.4%. That would imply around 50 basis points per meeting through through 4 meetings of the year. So it doesn't appear to be pricing another 75 basis points, although we are looking out for Powell, who could perhaps lean into more front loading. It's all speculative at this stage, mind you.
So the newsfeed brought to you by New Squawk. Guys, I would not live without. I think Reed will come on here and give us his view. You're seeing that softness now really coming into equities now. NASDAQ wiping out some of those gains, only up 0.8% here. So off to the downside. All right, watch out below now on equities. All right, as I was saying, 36.75's target down on SPOOs. The NASDAQ has an absolute country mile and then another country mile to go until 10.97's here. Lovely reaction. Lovely reaction. This is the NASDAQ. Sorry. All right, so I'm cutting the squawk there. So you're seeing NASDAQ here on the weekly. So really just a huge amount of demand here now taken back. So back to the 10.947s. Is that too far a stretch? Probably it is. Go back on the daily bars here and we'll see if what else we have here. I think that's just probably going to be a bit too far for the NASDAQ on this session where we sit now, you know. It does look quite bullish with this doji yesterday, you know, it really does. 75 basis points, you know, we're hearing from the statement that there isn't mention of another 75 basis point hike for the rest of the year. So maybe, you know, the market right now, we're watching it pricing in 75 basis rate hike and 37.52's long. Now I'm going to leave that trade for somebody else. I'm short this market and I'm not going to stand in front of an unexpected sort of rise on the base case here. You know, I think I'd rather see this thing get, you know, price in the 75 over the course of the rest of this session and, you know, tomorrow. And let's see what the dip buyers want to do. But, you know, we are down about 22.5% on the SPOOs from all year highs, all-time highs. So that is technically bear territory. All right, so we got that. It got this quiet, you know, 22 minutes now until we get Jerome. I think the way this is now set up, I think there's going to be a lot of attention on exactly what sort of language he uses about going faster if they need to on even stronger inflation to come. I think the market's going to want to need to hear that. You know, if we don't hear that, or if he kind of fluffs his response to, you know, how are they going to react now with these really rampant figures, I think the market's going to see that as incredibly hawkish, and so it should. So seeing value high just traded on SPOOs 37.60's half. A little bit of a setup there. We have been below. So that's one thing setting up for the speech, the presser. The other thing setting up is really, you know, are they going to do another 75? Now, who knows? And they're always going to have optionality in these pressers. He's not going to be like, well, this is exactly what we're going to do. Well, then that just gets priced in, right? So there'd be a lot of attention on basically that question, or the answer to that question. Are you prepared to do 75? And are you prepared to do 100 basis point hike? I think that's definitely a question we're going to get. Oil on the lows now, down 2%, 20 EMA to trade below, S2 after that, and 113.30s there. We have, quite. I don't know if we're gonna make it below 113.30s today on oil, but if we do trade there, I'll be looking for longs. 115.49s is the target to the auction downside here on oil. A breach on that is going to have a run probably to the 113.30s.
It's absolutely
Hollywood, what's up, man?
right. So I'll just try to make this as simple and as short as possible, really. So the prior terminal rate projection was at most at 1.9, and they've revised that to currently the projections go up to 3.4. So what the terminal rate is basically the peak of the of how far the Fed can actually raise rates.
So they're saying, where is that at the moment?
Right now, it's at 3.4. So the calculation's a bit like, it's a complicated thing, but the fair share projections now, right? So previously the target was 2.8, and then now they're looking at 3.8. That's huge. And second year 2.8, now projections go to 3.4. So these are not like, point increases, just massive. And
So,
the it's not just the fact that these it's much higher, like what GS, Goldman Sachs, and Morgan Stanley was, they keep talking about this, was the fact that they then there is a possibility that they need to hit the terminal rate a lot faster, because apparently the prior terminal rate, whereby they set a certain point where it peaks over there, and then probably just stays until they can then start to basically lower the interest rates again to perk up the economy. But now that's much higher.
so it's
And
it's sitting at 3.5 right now is what their sort of target rate is essentially.
Yeah. So and they might have to hit that faster because the inflation, basically because inflation is not coming down. They've
Yeah.
already raised rates and it's not coming down, so they might have to go a lot further. I mean, they are going a lot further, and we'll see what Jerome says later on, if they're going to go a lot faster in terms of what you said, if they're willing to do 75 again and again, because right now they're saying no, we are going to
or
be
100.
aggressive, but it's if they do 100, I mean, if you get like the next inflation read even higher, then there's really no choice. There's really no choice.
Yeah, so we could see some clean, simple action on the next CPIs, whereby if it comes in uber strong, the market may just want to price in like at least a 75 basis point rate hike, if not 100.
Definitely.
Yeah, and
Definitely.
we can pretty clearly just sell that. I mean, I don't think there's any kind of bad news is good news bullshit that we used to get in the QE
Obviously,
days.
obviously things can, like, because when during the last meeting, the data was very different, right? Projected data were very different. Obviously things can change, but as of now, as I said in the daily briefing today, why we saw the Dixie just kind of just pulled back really slowly was because we're pretty much priced in 75 basis points, right? So there was no, we weren't going a lot higher. The problem, not the problem, the question was, okay, we're going to get 75. We're trading right here, which is pretty much 75 basis points priced in. But are they going to keep doing 75 basis point hikes,
Yeah.
which means then we're too cheap.
Yeah,
Then
sure.
we'll go higher, and equity is gonna. By the end of the day, equity is just gonna get slapped, which they are.
So if I want to take a loan out to get my fleet of Lamborghinis repainted in canary yellow and one in canary pink for when Ollie comes over to visit, you're saying that now is the time to lock in that loan rate because shit's going to get wild later down the line.
I think you're about a year too late now. But
a year too late. Yeah, I was talking. I was talking to a hedge fund trader last week, and he was telling me that some Irish banks are already raising their rates ahead of Christine and ECB next month, and that had happened like 2 months ago. So yeah, it's getting tight out there. It's really getting tight. The party is over. Cheap money is gone. Now I want to get to a question here from Sean Grant. Hey Sean, how's it going? Good to see you. During the press conference, Sean says, I always notice there always seems to be a reversal in the markets during the press conference of FOMC before the big move. Could you make a comment on this? Yeah, so generally, you're seeing a little bit of a strength going back on VWAP on SPOOs. But yeah, so generally, what you get is a lot of expectations, a lot of book positioning coming into the event, and generally you get quite compressed trade coming into the event. Then when you get the event, a lot of algorithms hit in and execute, and a lot of institutional managers then are starting to work into the market. So they're not just going to hit the figure. Some algorithms and some institutions they'll hit the figure and it will push price. They'll be deploying a lot of volume over the figure, and that will expand price. Taking out a lot of price levels to the upside or the downside. Okay, people getting out of positions, people getting into positions, and I'm talking about thousands and thousands of contracts of equities and all sorts of stuff, right? Options, all that stuff kicking in here, right? And there's a lot of correlations working as well at the same time. But after you get that hot flush of the reaction we've seen now and this range spike we have across all the equities and dollar and euro now, and a little bit on cable and the bond, everything kind of then drifts back and reverts to the mean. And the mean was pretty much where the market was sat prior to the data coming out. So when you get this range expansion, to look at it through the eyes of, say, scalping traders and sort of the, other market participants, basically if we're average price on VWAP here for the day, volume weighted average price, right? And we come into the data and we're trading a bit expensive here. And then we get a lot of this deployment of size and execution of all sorts of stuff, coming through the market. It puts in a massive range, right? But then when all that size comes out of the market, well, as that size is being deployed, we kind of push to really two deviations above the mean and below the mean. Okay, two deviations. Now, I can actually show you this right now live, and we do provide some training on this, right? But I'll show you essentially real quick here. Turn this on. There and there. Okay, is it turning on? It's not. Why is it not turning on? Let me fix this here. I don't know why that's not switching on. Oh, there we go. No, it's not switching on. Let me try something else there. Okay, so here you kind of see 2 deviations up here. Now this actually went about 3 deviations up, and it only went 2 deviations to the downside. All right. So generally, there are algorithms that will kick in at these deviation points. Okay. So the market bottomed out here and it topped out here at 3 deviations. So 2 deviations at that time was more like here. So generally, there's a lot of averaging going on right there at that point. So, it kind of does pay to kind of know what's going on in terms of VWAP, average pricing. And a lot of traders will basically be selling something at 3 deviations up and buying something at 2 deviations down or 3 deviations down. And that's when you get that reversion back on the mean. And those traders will then get out at what they agree is an average price. So right now, the average agreed price is where we sit right now, after all that wash. So the hawkishness on the 75 basis point, I mean, it's really not that hawkish right now. Now the NASDAQ, just to kind of finish on that, Sean, and I hope that helps. It's not, no, I think it's all too easy to say it's stop hunting. It's not stop hunting. All right. That's just what people tell you because they don't understand what's happening. It's really to do with average pricing and sort of how far things are from the mean and from average. Okay. So, all right. So that's it. Now we have about 8 minutes until the data. So Hollywood, what do you reckon? End of day, new highs or new lows?
To be honest with you, a lot of the times it's more like you have the Goldman Sachs of the world saying things, and they're not wrong, but I've seen central bankers actually manage communication like extremely well when you don't expect them to. So I have no idea how Powell's going to play this to kind of temper market expectations, showing that he's really serious about bringing inflation down, but at the same time, not freak people out so much that, people don't think the world is burning.
Yeah.
Yeah.
I suppose actually just to continue with that makes me think, just to finish for Sean, it's that, before you get the presser, you get this volatility deployment of size. And then when you get the presser, so many people and market participants are actually monitoring what he's saying. He's not just up there to kind of read out what is printed and released to us, at the 7 o'clock marker. The market and the world is judging how he's delivering and saying, as Reed's talking about now, and so that can cause a whole new direction shift in the market. So essentially the 75 basis points is right now getting priced in. A certain amount of it, I think, was already priced in coming into this figure. I think we're gonna have new lows on the day, but yeah, as Reed is saying, when the central banker starts talking, as you go through the questions and you get really good questions, the way they answer them can totally shift the market on a dime, and you get a complete reversal, and then maybe that fakes out, and then you continue going the original direction.
If another thing is like the first 2 to 3 questions, if I'm not mistaken, are the ones that are actually important. And they are going to ask him, right? I mean, we know this. They are going to ask him, is he, literally what you just said early on, is he willing to put on, basically 75 basis point hikes to meet the terminal rate? Like, how fast does he see the Fed meeting the terminal rate? And the moment he said, yeah, definitely. I mean, anything along the lines of, yeah, 75 basis point hike for the next meeting is definitely on the table, you will see the Dixie fly through the roof.
Scream. You want to be...
Yeah, and equities are just going to get walloped.
Yeah. And that you're very quickly going to price in full-on recession, full-on Armageddon. But it won't be a time for him to stutter. I'll say that for nothing. Tell you that for nothing. And that's
Definitely.
part of the big job that these guys have. I mean, Christine Lagarde is amazing at delivering these statements because she puts it all out there on the table in such a delicate way that actually the market, the euro, the markets really don't go that crazy when Christine is speaking. I remember trading Draghi when he was head of the ECB, and things would go batshit wild, absolutely wild. Whereas really on the change of the bankers there, she seems to know how to release a statement and give the guidance coming into that as well. I mean, she's already taken 50 basis points off the table for the July meeting. So she's given that forward guidance. Yeah, it's 25, and shutting down then any banks kind of saying, oh, maybe it's going to be 50, maybe it's 75, so the market is steady all the way coming into that. Comes out at 25, the euro probably won't react at all.
I think sorry, Tim, just before we start, it's about 4 minutes, right? So how he could potentially play this is basically, okay, now it's driving season. One of the things driving inflation is fuel prices, right? So how he could potentially play this is the fact that, number one, it takes quite a while before any rate hike to actually translate into the economy. That's one. Second is, obviously, the war in Ukraine is ongoing and that affects fuel prices. But at the same time, we're driving season is not always going to be there. That's one. Second is
not at $6 a gallon. It's not.
Yeah, and second thing is demand destruction.
But doesn't everyone drive a Tesla now? Like everyone in America don't they drive a Tesla and live on avocados and smashed toast or smashed avocados and toast? Crew coming off here, targeting 20 EMA, coming down. We're looking at the Q plus 114.88 for buyers to step in on this after the 20 EMA. Seeing a little, there you go, through the 115.49s. That's FOE achieved for that auction. Yeah, 114.89s. This is getting really cheap now, below the 20. The 113s is just like so cheap. But, there's a little bit of dollar strength playing in here. A little bit of that going on. We have been very high for quite some time. But generally, looking back at oil here now, with 1.5 minutes to go for the statement. Quick look at oil on the daily. Here we are. This 113.30s, the high of the day on the 24th of March this year. All right, that's it for oil. Coming on down, I'll keep a close eye on that one as we come down here. And let's get this link up for the presser. I've actually found the YouTube feed is faster than the official feed, which is kind of cool in a way. All right, so I'm going to replace cable here with your own. So as Reed is saying, first three questions are the most important. Equities looking very weak, as you can see here, across the board. I've got VWAP on all these equities and oil just for those who trade it. Here we go.
Good afternoon. I will begin with one overarching message. We at the Fed understand the hardship that high inflation is causing. We're strongly committed to bringing inflation back down, and we're moving expeditiously to do so. We have both the tools we need and the resolve that it will take to restore price stability on behalf of American families and businesses. The economy and the country have been through a lot over the past 2.5 years and have proved resilient. It is essential that we bring inflation down if we are to have a sustained period of strong labor market conditions that benefit all. From the standpoint of our congressional mandate to promote maximum employment and price stability, the current picture is plain to see. The labor market is extremely tight, and inflation is much too high. Against this backdrop, today the Federal Open Market Committee raised its policy interest rate by 0.75 percentage point and anticipates that ongoing increases in that rate will be appropriate. In addition, we are continuing the process of significantly reducing the size of our balance sheet. I'll have more to say about today's monetary policy actions after briefly reviewing economic developments. Overall economic activity edged down in the first quarter as unusually sharp swings in inventories and net exports more than offset continued strong underlying demand. Recent indicators suggest that real GDP growth has picked up this quarter, with consumption spending remaining strong. In contrast, growth in business fixed investment appears to be slowing, and activity in the housing sector looks to be softening, in part reflecting higher mortgage rates. The tightening in financial conditions that we've seen in recent months should continue to temper growth and help bring demand into better balance with supply. As shown in our summary of economic projections, FOMC participants have marked down their projections for economic activity, with the median projection for real GDP growth running below 2% through 2024. The labor market has remained extremely tight, with the unemployment rate near a 50-year low, job vacancies at historical highs, and wage growth elevated. Over the past 3 months, employment rose by an average of 408,000 jobs per month, down from the average pace seen earlier in the year, but still robust. Improvements in labor market conditions have been widespread, including for workers at the lower end of the wage distribution, as well as for African Americans and Hispanics. Labor demand is very strong, while labor supply remains subdued, with the labor force participation rate...
Just going in here, you can see equities on this hawkishness on the 75 as predicted here. It's heavy, right?
Easing the upward pressures on wages and prices. The median projection in the SEP for the unemployment rate rises somewhat over the next few years, moving from 3.7% at the end of this year to 4.1% in 2024, levels that are noticeably above the March projections. Inflation remains well above our longer run goal of 2%. Over the 12 months ending in April, total PCE prices rose 6.3%, excluding the volatile food and energy categories. Core prices rose 4.9%. In May, the 12-month change in the Consumer Price Index came in above expectations at 8.6%, and the change in the core CPI was 6%. Aggregate demand is strong. Supply constraints have been larger and long-lasting than anticipated, and price pressures have spread to a broad range of goods and services. The surge in prices of crude oil and other commodities that resulted from Russia's invasion of Ukraine is boosting prices for gasoline and food and is creating additional upward pressure on inflation. And COVID-related lockdowns in China are likely to exacerbate supply chain disruptions. FOMC participants have revised up their projections for inflation this year, particularly for total PCE inflation, given developments in food and energy prices. The median projection is 5.2% this year and falls to 2.6% next year and 2.2% in 2024. Participants continue to see risks to inflation as weighted to the upside. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks high inflation poses to both sides of our mandate, and we're strongly committed to returning inflation to our 2% objective. Against the backdrop of the rapidly evolving economic environment, our policy has been adapting, and it will continue to do so. At today's meeting, the committee raised the target range for the federal funds rate by 0.75 of a percentage point, resulting in a 1.5 percentage point increase in the target range so far this year. The committee reiterated that it anticipates that ongoing increases in the target range will be appropriate. And we are continuing the process of significantly reducing the size of our balance sheet, which plays an important role in firming the stance of monetary policy. Coming out of our last meeting in May, there was a broad sense on the committee that a 0.5 percentage point increase in the target range should be considered at this meeting if economic and financial conditions evolved in line with expectations. We also stated that we were highly attentive to inflation risks and that we would be nimble in responding to incoming data and the evolving outlook. Since then, inflation has again surprised to the upside. Some indicators of inflation expectations have risen, and projections for inflation this year have been revised up notably. In response to these developments, the committee decided that a larger increase in the target range was warranted at today's meeting. This continues our approach of expeditiously moving our policy rate up to more normal levels, and it will help ensure that longer-term inflation expectations remain well anchored at 2%. As shown in the SEP, the median projection for the appropriate level of the federal funds rate is 3.4% at the end of this year, a percentage point and a half higher than projected in March, and 0.9 percentage point above the median estimate of its longer run value. The median projection rises further to 3.8% at the end of next year and declines to 3.4% in 2024, still above the median longer run value. Of course, these projections do not represent a committee plan or decision, and no one knows with any certainty where the economy will be a year or more from now. Over coming months, we will be looking for compelling evidence that inflation is moving
Buyers
down,
back on the spoos
consistent
here.
with inflation returning to 2%.
On equities across the board, buyers coming in.
That ongoing rate increases will be appropriate. The pace of those changes will continue to
don't
depend
buy
on
it,
the
though.
incoming data and the evolving outlook for the economy. Clearly, today's 75 basis point increase is an unusually large one, and I do not expect moves of this size to be common. From the perspective of today, either a 50 basis point or a 75 basis point increase seems most likely at our next meeting. We will, however, make our decisions meeting by meeting, and will continue to communicate our thinking as clearly as we can. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Making appropriate monetary policy in this uncertain environment requires a recognition that the economy often evolves in unexpected ways. Inflation has obviously surprised to the upside over the past year, and further surprises could be in store. We therefore will need to be nimble in responding to incoming data and the evolving outlook. And we will strive to avoid adding uncertainty to what is already an extraordinarily challenging and uncertain time. We are highly attentive to inflation risks and determined to take the measures necessary to restore price stability. The American economy is very strong and well positioned to handle tighter monetary policy. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Okay.
Thank you. Howard Schneider with Reuters. Two related questions. Chair Powell, Did you feel you boxed yourself in with the language you used at the last press conference on 50 basis point hikes in June and July? And would you please give us as detailed a sense as you can of what role you played in reshaping market expectations so quickly on Monday?
So, as you know, we always aim to provide as much clarity as we can about our policy intentions, subject to the inherent uncertainty in the economic outlook, because we think monetary policy is more effective when market participants understand how policy will evolve, when they understand our objective function, our reaction function. And in the current highly unusual circumstances with inflation well above our goal, we think it's helpful to provide even more clarity than usual, again, subject to uncertainty in the outlook. So, and I think over the course of this year, financial markets have responded and have generally shown that they understand the path we're laying out. Of course, it remains data dependent, and so that's what we generally think about guidance, and that's why we offer it. And of course, when I offered that guidance at the last meeting, I did say that it was subject to the economy performing about in line with expectations. I also said that if the economy performed, if data came in worse than expected, then we would consider moving even more aggressively. So we got the CPI data and also some data on inflation expectations late last week, and we thought for a while, and we thought, well, this is the appropriate thing to do. So then the question is, what do you do? And do you wait 6 weeks to do it at the next meeting? And I think the answer is that's not where we are with this. So we decided we needed to go ahead, and so we did. And that's really how we made the decision.
Okay, Gina?
All right, watch out. Equities are pricing this all in. Market does not give a shit. Target up on SPOOs 38.77.
I guess I wonder if you could describe for us a little bit how you're deciding how aggressive you need to be. So obviously 75 today. What did 75 achieve that 50 wouldn't have, and why not just go for a full percentage point at some point?
Sure. So if you take a step back, what we're looking for is compelling evidence that inflationary pressures are abating and that inflation is moving back down. And we'd like to see that in the form of a series of declining monthly inflation readings. That's what we're looking for. And by this point, we had actually been expecting to see clear signs of at least inflation flattening out and ideally beginning to decline. We've said that we'd be data dependent, focused on incoming data, highly attentive to inflation risks, the things that I mentioned to Howard moments ago. So contrary to expectations, inflation again surprised to the upside. Some indicators of inflation expectations have risen, and projections of this year have moved up notably. So we thought that strong action was warranted at this meeting, and today we delivered that in the form of a 75 basis point rate hike, as I mentioned. So what was the point of it really is this. We've been moving rates up expeditiously to more normal levels. And over the course of the 7 months since we pivoted and began moving in this direction, we've seen financial conditions tighten, and appropriately so. But the federal funds rate, even after this move, is at 1.6%. So again, the committee is moving rates up expeditiously to more normal levels, and we came to the view that we'd like to do a little more front-end loading on that. So I think that the SEP gives you the levels that people think are appropriate at given points in time. This was really about the speed with which you would get there. So as I mentioned, we 75 basis points today. I said the next meeting could well be about a decision between 50 and 75. That would put us at the end of the July meeting, in that range in that more normal range, and that's a desirable place to be because you begin to have more optionality there about the speed with which you would proceed going forward. Just talking about the SEP for a second, what it really says is that committee participants widely would like to see policy at a modestly restrictive level at the end of this year. And that's 6 months from now. And so much data and so much can happen. So remember how highly uncertain this is. But so that is generally a range of 3 to 3.5%. That's where people are. And that's what they want to see, knowing what they know now and understanding that we need to be we need to show resolve, but also be flexible to incoming data as we see it. If things are better, we don't need to do that much. And if they're not, then we either do that much or possibly even more. But in any case, it will be very data dependent. Then you're looking at next year, and what you're seeing is people see a bit more tightening and in a range of maybe 3.5% to 4%. And that's generally what people see as the appropriate path for getting inflation under control and starting back down and then getting back down to 2%. So 75 basis points seem like the right thing to do at this meeting, and that's what we did.
Steve Leisman, CNBC. Thank you for taking my question, Mr. Chairman. You have not used the phrase in a long time, monetary policy is in a good place, which is a phrase that you used to use often. Now that the committee is projecting 4% or 3.8% next year in terms of the funds rate, which is similar to where the market is now, the futures market of 4% funds rate next year. Do you think that's a level that is going to be sufficiently high enough to deal with and bring down the inflation problem? And just as a follow-up, could you break that apart for me? How much of that is restrictive, and how much of that is a normal positive rate that ought to be embedded or not, in your opinion, in the funds rate? Thank you.
Sure. So the question really is, how high does the rate really need to go? And this is, the estimates on the committee are in that range of 3.5% to 4%. And how do you think about that? Well, you can think about the longer run neutral rate. You can compare it to that, and we think that's in the mid twos. You can look, frankly, at broader financial conditions. You can look at, asset prices. You can look at the effect you're having on the economy, rates, asset prices, credit spreads. All of those things go into that. You can also look at the yield curve and ask, all along the yield curve, where is the policy rate? So for much of the yield curve now, real rates are positive. That's not true at the short end. At the short end of the yield curve in the early years, you don't have you have negative rates still. So that really is one data point. It's one part of financial conditions. So I think I have to look at it this way. We move the policy rate, that affects financial conditions, and that affects the economy. We have, of course, rigorous ways to think about it, but ultimately it comes down to, do we think financial conditions are in a place where they're having the desired effect on the economy? And that desired effect is, we'd like to see, demand moderating. Demand is very hot still in the economy. We'd like to see the labor market getting better in balance between supply and demand. And that can happen both from supply and demand. Right now, demand is substantially higher than available supply, though. So we feel that there's a role for us in moderating demand. Those are the things we can affect with our policy tools. There are many things we can't affect, and those would be, the things, the commodity price issues that we're having around the world due to the war in Ukraine and the fallout from that, and also just all of the supply side things that are still pushing upward on inflation. So that's really how I think I would think about it.
But does 3.8%, 4% get it done? Does it get the job done and breaking the back of inflation?
I think it's certainly in the range of plausible numbers. I think we'll know when we get there, really. I mean, honestly, that would be, you would have positive real rates, I think, and inflation coming down by then. I think you'd have positive real rates across the curve. I think that the neutral rate is pretty low these days, so I would think it would. But you know what? We're going to find that out empirically. We're not going to be completely model driven about this. We're going to be looking at this, keeping our eyes open and reacting to incoming data, both on financial conditions and on what's happening in the economy.
Thank you, Nick.
Thanks. Nick Timmeros of the Wall Street Journal. Chair Powell, you've said that you like your policy to work through expectations, and now obviously this decision was something quite different from how you and almost all of your colleagues had set those expectations during the intermeeting period. And I know you just said that what changed was really the inflation data, the inflation expectations data, but I'm wondering, on the inflation expectations data, was there something you saw that was unsettling enough to risk eroding the credibility of your verbal guidance by doing something so different from what you had socialized before?
So,
Wow, shots fired there.
We look at a broad range of inflation expectations. So you've got the public, you've got surveys of the public and of experts, and you've also got market-based. And I think if you look across that broad range of data, what you see is that expectations are still in the place, very much in the place, where short-term inflation is going to be high, but comes down sharply over the next couple of years. That's really where inflation expectations are. And also, as you get away from this episode, they get back down close to 2%. And so this is really very important to us that remain the case. And I think if you look for most measures, most of the time, that's what you see. If we even see a couple of indicators that bring that into question, we take that very seriously. We do not take this for granted. We take it very seriously. So the preliminary Michigan reading, it's a preliminary reading. It might be revised. Nonetheless, it was quite eye-catching, and we noticed that. We also noticed that the index of common inflation expectations at the board has moved up after being pretty flat for a long time. So we're watching that, and we're thinking, this is something we need to take seriously. And that is one of the factors, as I mentioned, one of the factors in our deciding to move ahead with 75 basis points today was what we saw in inflation expectations. We're absolutely determined to keep them anchored at 2%. That was one of the reasons. The other was just the CPI reading.
So if you saw a movement like that again, another tick up in inflation expectations, would that put a 75 or even 100 basis point increase in play at your next meeting?
You know, I'll just say we're going to react to the incoming data, and appropriately, I think. So I wouldn't want to put a number on what that might be. The main thing is to get rates up, and then pretty soon we'll be in an area where we're, I think, as you get closer to the end of the year, you're in a range where you've got restrictive policy, which is appropriate. 40-year highs in inflation. We think that policy is going to need to be restrictive, and we don't know how restrictive. So I think that's how we'll take it.
Hi, Chair Powell. Neil Irwin from Axios. Thanks for taking our questions.
All right, I'm just going to take an opportunity here to check in. Reid, what do you reckon?
If I could speak to Powell, I'd be like, wow, nicely done. He didn't answer the question at all.
He didn't answer it at all. He's kept it wide open. Wide open.
That was so good. Oh my God.
So it'll be more fireworks for the next one. You seen, Spoo's kind of pushing up here. Generally, a bit of talk that this isn't a big deal, and that it's all in hand, and that they are well suited to deal with any further monetary issues. But I see this bid as absolute vaporware bullshit right now. I think really nice selling opportunities around there. It did go deep above the 38.09s quarter. Oil, actually, now that this chart has stopped printing candles because we've had the close, but nice little bid off of the 114.89s. Anyway, Reid, what do you reckon? Where do we go from here?
Did you, like the language he used, right? I mean, before I got to charts or anything, like, the language he used, he literally pulled a Lagarde.
Yeah, he did.
Like, yeah, when they asked her, because she completely just pivoted, right? As in, and completely uninterested to engage. That's exactly what he did. Just, I'm not going to engage with this.
The only difference is that Christine gives like a lot of forward guidance, as in, on this July hike, she said, we're doing 25. That's it. And like unequivocally, there's nothing about it, nothing more about it. So that's not even going to be a question coming in. Whereas, Jerome there didn't answer the question about what he's going to want to do in the next one, but he's dealing with a slightly wilder inflation beast than we are in Europe.
And pretty much what he said was, if you encapsulate everything, it's just, I don't know. That's literally what he said. I don't know.
Yeah.
And that's kind of scary, because by the end of the day, what was really important that the Fed showed basically like they're ahead, not even ahead, like they needed to control the narrative and show they're not behind the curve, as in they kind of have an idea where this is going. and he just literally said, "I don't know." He sounded so tired.
I don't think they do know. I don't think they do have a clue where this is going. Like the energy picture is deteriorating, constantly deteriorating with this situation with gas now. It's just getting worse and worse, and that's going to have a trickle-on effect to your headline CPIs essentially, and you know, and it is going to have a trickle-across effect to your core CPIs as well. So, you know, I think he's telling the absolute truth when he doesn't know where this is going, but he can't come out and say, "Shit, I don't know," because it's his job to kind of get this shit under control. So, yeah.
I reckon we might get bigger ranges, to be honest with you, like much bigger pullbacks, because it's literally not. I mean, we can see the terminal rate going higher. Basically the federal funds rate target is currently higher. So, but he's not saying whether 75 basis points is going to be on the table for the next meeting or any meeting thereafter. So it's like, okay, we're kind of priced in there, but where do we go in equities?
I don't know. I actually don't know.
Yeah, I think that's kind of like where the market is right now. Like they don't know, because we're.
You know what? I think with that level of doubt and dissonance, I think it's just got to go down. I think people are going to go to cash. I think people are going to continue going, you know, to bonds, to safety. People are going to want their cash.
Might actually, yeah.
You know, seeing a lot of outflows on ETFs.
And if but at the same time, like you'll see these, like, you know, we'll sell down, no doubt, but at the same time, like I do think like the pullbacks are going to be horrendous as well, to like kind of like catch like you know, like the 2 days, the prior 2 days of price actions. I don't think it's going to be like exactly like that. We might see huge rips and then just pullbacks and a lot of confusion.
You mean obviously rips to the downside and then massive pullbacks back up?
Yeah.
Yeah. Well, I was expecting a bit of that now, and we've only come as far as below the R2 here on SPOOs. We still have this gap remaining, 38.77's quarter low. It hasn't even got there. I mean, this is going to be like that gap that we had from March last year. It's going to be left open for a year. And bear market.
What I do think, right? So right now Dixie's holding 104. At low of day is pretty much the weak support. If you can't hold that, and we just dip down and going for a test of like 104s, and in actuality, the real test here, about 103, 832s, there and thereabouts. So give and take 104s. So if you can't hold that and go for like a test of 104, but equities don't rally, on that dip, if it gets sold down, everyone's going to be caught offside.
So you're saying
you'll see much bigger rips, yeah.
So you're saying dollar comes down, equities don't rip to the upside, then the dollar will surge again, or the dollar will go for another leg up.
Not the dollar will surge, because you'd expect equities to at least recover a little bit on like a softer dollar. But if it doesn't, then equities are gonna just get hit, because it's like everyone's like, okay, no one's buying. The dollar's going down, but no one's buying. Right? So risk appetite is just nil.
So, then you should get a free fall capitulation, low volume, push to the downside. Everyone's just running for the doors or just holding. Yeah, okay. Well, I could get on board with that.
Everyone's going to try and get out because they're like, why isn't anyone buying? And just get out.
So you're the resident gold bug left in the room.
No, I'm
since Mike is gone.
No, I'm not. I haven't traded gold since June last year.
So, well, what do you reckon for gold? Is this the time? I don't think so.
Nah,
It's taken a bit here, but I don't think so. I mean,
no.
well,
Gold just hasn't done anything it's supposed to. It hasn't done anything it's supposed to. It hasn't been a safe haven. It hasn't been a hedge for inflation. It hasn't, gone up when the dollar's down. It hasn't gone down when the dollar's up. It's just there.
Well, we got Bitcoin. I mean, Bitcoin is toast, man. Toast. 18,440s target here down on Bitcoin. That's going to be the high of the week of the 24th of June, 2019. And I wouldn't be surprised to see that thing break as well, to be honest. This is CME data here. Yeah, I mean, it's having a terrible time. Lovely break here on the trend, or sorry, on the range and on trend. So quite clear technical trading to be done there for the short. So some nice ops to be had if you're a short seller on Bitcoin recently. And yeah, well, I mean, if we go to the 60-minute, are we going to see that finally Bitcoin may be a risk asset? And whoa, well, hold on a second. It actually that is a first. I have to say that is a first. We actually have seen Bitcoin take quite a pump on that to the upside. That is interesting. That's the first time I've seen that happen. Actually, has anyone else seen that happen over an FOMC? To what, 10% push? Okay, maybe this could be a catalyst for Bitcoin. I'm not buying any Bitcoin on the back of that potential, but we'll see. All right, well, that's 8 o'clock, and I'm going to leave you guys and girls here. Stay long on oil from that dip is what I'm prescribing here. This is not investment or trading advice, though. And listen, Reed, thank you very much. All the guys on YouTube, Van Deep, Josh, Sean, Brian, Crypto Consultant. What's up? Yeah, gold, exactly. At least you're not in Bitcoin. Well, it did all right over this FOMC. I've never seen it react like that over that type of risk event. So watch that space. All right. Thanks for tuning in. It's been a pleasure as always. I'm going to go and grab a beer, and I will see you all 8 bells in the morning for the European session. If you haven't clicked the subscribe or like, please do. It means a lot to us. And yeah, sleep well. Bye-bye.